Welcome, dear traders, it's me, Kate Stichin, and you are watching a recap of the Asian session. Stocks in Japan, Australia and in New Zealand declined sharply at the end of the week. Cautious sentiment prevailed again, especially after published economic reports and ahead of the US PMI indexes. This week, several central banks, namely the Fed Reserve, the Bank of England and the Swiss National Bank, raised their key rates. To some extent, they had no choice but to maintain aggressive tightening. Inflation is still high and it may again start climbing. However, the Fed is facing more serious problems. It's caught between a rock and a hard place due to the banking crisis. At first, the government pledged to support depositors of collapsed banks. Then Treasury Secretary Janet Yellen warned that regulators were not looking to provide blanket deposit insurance to stabilize the banking system. Yesterday, she said that the federal emergency auctions to back up Silicon Valley Bank and Signature Bank customers could be deployed again in the future if necessary. In other words, the government does not rule out the continuation of the crisis. However, pausing the tightening cycle would mean the Fed's failure to cap inflation. It would eventually lead to greater havoc, making it hard for the Fed to restore price stability. Yet the regulator does not seem worried about the current situation. Jerome Powell again stated that there is a path to a soft landing. A soft landing is a smooth decline in consumer prices to the target of 2%, a stable labor market and a strong national currency, even if the US economy is on the verge of a recession and the regulator will hardly abandon aggressive tightening. The Fed chair vowed to raise rates to fight inflation until the job is done. The main priority is to curb soaring inflation. Monetary tightening may undermine economic expansion. However, the Fed should act decisively so that the US dollar retains its status as the world's dominant reserve currency. While the Fed is trying to find a balance between taming inflation and easing fears about the banking sector, the US dollar consolidated at 102.60 on Friday. It recouped some of its early losses, even despite the Fed's hints at a pause in aggressive tightening. After a sharp rise from yesterday's low of 101.90, the US dollar index resumed moderate bullish momentum. In the Asian session, it was moving within the range of 102.50 and 102.70. The price corridor is very narrow and looks more like consolidation. If it settles above the 102.30 level, it will indicate a strong bullish bias. If so, the US currency could climb to 102.90. However, the main trend remains bearish. If the greenback declines below 101.50, bears are sure to take control. Its further trajectory will largely depend on fresh economic reports. Japan unveiled economic data in the morning. The figures turned out to be positive and the employment rate increased. Machinery orders showed the strongest rise over the past 10 months. Japan's core consumer prices sharply declined from a 40-year high of 4.2% in January to a 5-month low of 3.1% in February. This reading is close to the Bank of Japan's 2% inflation target, and the Japanese regulator feels more relaxed now than most of the world's central banks. It seems that the 10-year ultra-loose monetary policy is bearing fruit. However, the recent banking crisis in the United States and Europe has increased the risks for the country's exports. It may also trigger a slowdown in economic growth in China, Japan's largest trading partner. Import prices keep rising due to weak yen and inflation triggered by soaring energy costs. Nevertheless, bulls are still in control. Ahead of the US economic reports, the dollar-yen pair is consolidating in the range of 129.90 and 130.93. On a Friday morning, the pair declined lower. It continued its three-day downtrend, trading at 103.30 in the Asian session. The price reached the support level of 130.50. After that, it tested the psychologically important level of 130. The fiscal year ends in a week. Japanese companies usually convert their dollar profits into the yen, and the latter looks strong today, confirming its status as a safe haven asset. Therefore, buyers may try to push the pair below the key level. After breaking through 130, the yen may move even lower to the February lows of 129.30 and 128. If they succeed, the price could dive to the early low of 127.20. Commodity currencies dipped on Friday, and the Australian dollar broke through the support level of 0.6670 for the first time in 3 days and fell to 0.6665. It could end this week with bigger losses. In the Asian session, the AUD-USD pair was trading in the bearish channel of 0.6660 and 0.6694. So the Australian dollar has acted as a risk barometer. Besides, apart from the concerns over the banking crisis and the Fed stance, the Aussie decreased due to weak data on the composite PMI index. The composite PMI in Australia decreased significantly. It fell to 48.7 in March, a reading below the forecast, and the 50 signals a contraction. And this is hardly surprising that traders opened short positions amid such downbeat data. This is why the Australian dollar dropped in the Asian session. The New Zealand dollar also dipped in the morning. It was trading at 0.6216. It's unable to rise due to a strong bearish trend. The Kiwi is likely to slide lower today. In the Asian session, it was fluctuating in the range of 0.6211 and 0.6255. And that's all for now. Please leave your comment down below, and we wish you only profitable trades and with InstaForex. See you soon!